Greg, what's so important is we just heard from Greg Boutle with a pretty optimistic view of where this economy's going. Your base case starts with economists who are more cautious, aren't they?
Yeah, absolutely. So we think we could see a slowdown in the second half of this year. The one part of the data that we think could be a bit firmer is still the labour market data, the wage data. So we think that creates an environment in the second half of the year where we could see some margin contraction.
You and your research don't do a great job of linking nominal top-line GDP into U.S. equity performance. Discuss that linkage.
Yeah, so the thing that we look at is a macro earnings model where we put in inputs, things like nominal GDP, wages, and other macro variables, and track how that tends to fall through into bottom line corporate earnings. And what we see is there's a good relationship between some of these economic variables. And if we see an environment where we do see a top line growth slowdown, but we do see rising input costs, so we see oil this morning, and we see rising wage costs, that's an environment that typically drives margin compression and puts pressure on bottom line earnings.
So put this together, what are you telling clients to do?
So for us, with the market having had such an aggressive rally at the start of this year, and we're seeing a much less favourable environment in terms of corporate earnings, we're telling clients to become more defensive.
So what about the IPOs? Because we have a whole host of IPOs coming out. We saw the Lyft completely bomb the IPO, and now there are lawsuits that have already come out 3 weeks later. You had Pinterest and Zoom Video do very well. So what is this telling you about the appetite of going forward?
So clearly, some of that is kind of stock by stock and due to those individual equity fundamentals. But I think generally that environment where we see some of these IPOs come to the market that don't have any earnings, I think this could be read as a sign that we're kind of in a late cycle environment.
What's great about your note, it's very complex. There's collars, there's throughway trades and all that. What are the pros actually doing? Did they miss this great bull market bounce?
Yeah, absolutely. I think there are a lot of equity investors who have missed at least the first leg of the rally and have now started to put money to work. So I think we're in a position now where if the market continues to grind higher, it does force people's hands and people do have to take some risk.
Oh, it's terrible, Lisa. We're up 15.9% SPX year to date. It's single-digit return.
Well, I mean, honestly, it's terrible for all the people who piled into cash last year because that was the most popular trade.
Why are you looking at me? Come on.
Tom, do you have something to tell us?
I'm in the triple leveraged all cash fund.
All right.
No, I feel safe.
But, so, Greg, if they're coming out now, if they're pouring their money into equities now, U.S. equities, are they going to get burned? Are they coming too late?
Well, I think there's definitely a risk that if anyone's being forced to put cash to work now, that we're late in the cycle, and if we see the type of slowdown that we see in the second half this year, it doesn't feel like a great level for us, at least in terms of the broader index, to be putting money to work.
How big is the slowdown later this year?
We're not looking for an aggressive slowdown in terms of the macro numbers. I think our US growth forecasts are down to kind of trend growth rates, but where we have sub-trend growth coming through from other economies such as Europe and Japan, we do think it's something that could translate into a more aggressive slowdown in earnings than we see in the GDP numbers.
Lisa had a great chart earlier, the disparity between big stocks and little stocks right now. You do that in your report as well. How do you arbitrage that? Do you stay on big stocks or do you buy the smaller stuff because it hasn't kept up?
No, our view is that actually the underperformance from the small and mid caps is something that we could see actually accelerate in the second half of the year. We think that generally the small cap corporates have more expensive valuations, they have less pricing power, and we think the earnings environment for the small caps could deteriorate further.
So what are pros going to do? I mean, I make a joke about it. We're up 15.9%. There's somebody out there who's lost their bonus into next year. They're up 7% right now. They're 800 basis points behind, and life is miserable. What is that behavior in the next 60 days?
Well, I think one of the things you have to try and do is find some idiosyncratic stories. We have a huge number of corporates from the S&P reporting this week, and one of the things that we expect to see going forward is more of an environment of winners and losers. So those who can deliver strong earnings are likely to outperform, and we think those who can't could well suffer.
Going back to the sort of small cap versus large cap, so you're saying there could be an opportunity in small cap. Miller Tabak's Matt Maley was coming out and saying that actually the Russell 2000 tends to be a leading indicator. Right now, it is leading with negativity. And how come you're confident that's not what's going on?
I know. So our view is actually that we think the small caps could continue to underperform.
Oh, okay.
So we actually think that it is probably a leading indicator of the broader market. And we think that just the financial health of some of these small caps, they tend to be less profitable, valuations tend to be worse. We think they tend to be more exposed to an end of cycle environment. So I actually think the underperformance that we've seen from the small caps could continue.